Let me ask you something that should bother you more than it does. You work hard, you earn money, you deposit it in a bank. And then on a Friday afternoon, when you try to move that money, you're told to wait until Monday. No explanation, no apology, just wait. Meanwhile, that same bank is using your deposit right now, tonight, over the weekend, generating returns you will never see. That's not a glitch. That's not outdated technology. That is a deliberate design. And right now, there are powerful organizations spending millions of dollars in lobbying fees to make sure that design is never disrupted. Today, we pull back the curtain on exactly who they are, what they filed, and why it actually confirms everything XRP holders already suspected. Welcome back to Ledger Wealth Network. I don't deal in hype. I don't deal in hope. I deal in documented evidence, institutional behavior, and the kind of structural analysis that most channels don't have the patience for. Today's briefing is dense. It is important, and if you stay until the end, your understanding of this market will never be the same. Let's get into it. Let's start with a hard truth most people don't want to look at directly. The traditional banking system is not a storage system. It is an extraction system, and fractional reserve banking is the engine that makes it work. Here is how it actually functions. When you deposit money in a bank, they are legally only required to keep a fraction of that on hand. Historically around 10%, and in some cases even less. The rest, deployed, invested, lent out at rates far higher than what you will ever earn. You might receive 2% on a savings account. That same institution could be generating 12%, 15%, or more on the capital you handed them. The spread between those two numbers is not incidental. It is the entire business model. Now ask yourself this, what happens to that business model the moment money can move instantly, transparently, and without sitting inside their system for a single unnecessary second? It collapses. This is not theory. This is why XRP was designed the way it was. The XRP ledger settles a transaction in 3 to 5 seconds. There is no weekend. There is no clearing delay. There is no float window for a bank to exploit. The moment funds move, they arrive. And that single technical reality is worth trillions of dollars to the institutions whose profits depend on the exact opposite happening. Now, most people watching crypto news are focused on price charts, on sentiment cycles, on what some influencer said this week. But the real story, the one that actually matters, is playing out in regulatory filings, lobbying letters, and formal objections submitted to government agencies. Because here's what the smart money knows that retail doesn't. The battle for the future of finance is not happening on Twitter. It is happening in conference rooms in Washington, D.C. And the institutions that have the most to lose are the ones who know exactly where to fight. They are not panicking, they are not confused, they are organized, funded, and executing a very deliberate strategy. And we now have the documentation to prove it. Let's talk about scale, because without numbers, this remains an abstract argument. The global cross-border payments market processes roughly $150 trillion annually. The foreign exchange market alone clears approximately $7.5 trillion every single day. And sitting inside the legacy correspondent banking system right now is an estimated $27 trillion locked in Nostro and Vostro accounts. Capital that is frozen, earning nothing, simply waiting to facilitate future transactions. That is $27 trillion that could be put to work, that could be freed the moment a more efficient bridge asset takes its place. Now here's where the math becomes uncomfortable for the traditional system. XRP has a fixed total supply of 100 billion tokens. Of that, roughly 55 to 57 billion are in circulation. A significant portion of exchange reserves are sitting at multi-year lows, which on-chain data from sources like CryptoQuant and Glassnode has been tracking in real time. Every token that leaves an exchange and moves into long-term custody is a token removed from liquid supply. Think about what that means when institutional demand arrives not gradually, but in volume. Here's the math that the crowd ignores. If XRP is going to function as a bridge asset moving even a fraction of that $150 trillion annually, the price is not a sentiment number. It is a liquidity requirement. You cannot move sovereign-level capital through a bridge asset that doesn't have the market depth to support it. The price has to reflect the utility. That is not a prediction. That is a design requirement built into the architecture of how on-demand liquidity actually works. Brad Garlinghouse has said publicly that XRP's value is directly connected to its utility. David Schwartz, the chief technology architect of the XRP ledger, has explained the mechanics of liquidity depth in detail. These are not Moonboy talking points. These are technical realities that institutional treasury managers understand before they ever sign an agreement with Ripple. The math doesn't care about your emotions. It doesn't care about short-term price swings. It cares about whether the numbers work at scale, and at scale, they only work one way. Now let's look at what is actually being documented, because this is where the story gets undeniable. The Independent Community Bankers of America, the ICBA, recently submitted a formal objection to a crypto-native banking application. This is not opinion. This is a documented regulatory filing. And when you read it carefully, something becomes immediately clear. They didn't limit their concern to the applicant in question. They specifically referenced Ripple, Circle, and Paxos by name. Let that register. A major banking lobby group representing institutions connected to some of the largest financial names in the United States filed a formal government document naming Ripple as part of the competitive landscape they want to contain. That is not a warning sign for XRP. That is validation. Because organizations like the ICBA and the Bank Policy Institute, which represents over 40 of the largest U.S. banks, including names you interact with every single day, do not spend political capital on threats that aren't real. They do not file letters with federal regulators about technology they believe will fail on its own. They file because they are genuinely threatened. And they are threatened because the technology works. Ask yourself this. Does an institution like BlackRock enter a space without absolute legal and structural certainty? Does Franklin Templeton, which has been quietly building blockchain-based fund infrastructure, do that on a whim? These are not retail investors chasing momentum. These are firms with compliance teams, legal departments, and fiduciary obligations. When they move, they have already done the analysis. They have already made the conclusion. The fact that traditional banking lobbies are now formally opposing crypto banking licenses is not a bearish signal. It is the most bullish signal possible because it means the incumbents have looked at the math, looked at the technology, and decided they cannot afford to let this proceed without a fight. That fight is confirmation that the threat is real, and the silent actors on the other side of that fight are already positioning. So where does this go from here and when? The Digital Asset Clarity Act, currently moving through legislative channels, represents the single most important regulatory development this space has seen. If passed, it creates a defined legal framework for how digital assets are classified, regulated, and integrated into existing financial infrastructure. That framework removes the single largest barrier that institutional capital has cited for staying on the sideline: legal uncertainty. The moment that uncertainty is removed, the gates open, not slowly, not gradually. The capital that has been waiting, from sovereign wealth funds, from pension systems, from corporate treasury managers, does not trickle in. It flows. Ripple's recent acquisition of Hidden Road, a prime brokerage platform serving institutional clients, is not a coincidence. That is infrastructure being assembled in advance of that moment. You don't build prime brokerage capacity for retail. You build it for institutions preparing to move. The FDIC's softening posture on crypto custody. The OCC revisiting guidelines on bank participation in digital asset markets. Japan's Financial Services Agency signaling new frameworks. These are not isolated headlines. They are the sequential pieces of a structure being built in plain sight. The window to be positioned ahead of that structure completing is not unlimited, and the lobbying resistance we are seeing right now is actually the clearest possible signal that we are close, because they only fight this hard when they know they are running out of time. Here is what I want you to understand about timing. Every market cycle in history has had a moment where the fundamentals were clear, the evidence was documented, and the only thing separating outcome from opportunity was patience and positioning. Those who were already in place before the catalyst didn't need perfect timing. They needed to have done the work early enough. XRP exchange reserves are at levels that on-chain forensic analysts have flagged as historically significant. When supply leaves exchanges and doesn't return, it means holders are not looking to sell at current prices. They are waiting for a reality that the numbers already point to. This is not FOMO language. FOMO is emotional. What I'm describing is structural. The lobbying letters are filed, the banking applications are under pressure, the institutional infrastructure is being assembled, the regulatory framework is being written. These are not future events, they are current events. The math is already in motion. The question is not whether this resolves. The question is whether you are positioned before it does, or whether you are watching it happen from the outside, wondering how you missed it. The crowd will figure this out later. The informed already know. The fuse has been lit. The only variable now is your position when it goes off. Let me bring this home. What we covered today is not speculation dressed up in confident language. It is documented institutional behavior, on-chain data patterns, and regulatory developments that form a coherent picture when you look at them together instead of in isolation. The banks are not fighting XRP because they think it will fail. They are fighting it because they know what happens if it succeeds. And their resistance, filed in writing, submitted to regulators, funded by the largest financial institutions on Earth, is the clearest possible confirmation that the technology is real, the threat is real, and the outcome is being decided right now. If you got value from this analysis, subscribe. Share this with someone who needs to understand what is actually happening behind the headlines. Comment the word Ledger below if you made it to the end. I want to know who is actually paying attention. Stay patient. Stay rational. The math doesn't lie, and the system is almost complete.